In the last video, we talked about the shocking truth about mismanaging your money. Now that we've seen the examples of how financial inaction and poor decisions can cost you dearly, in this video it's time to dive into the most important part of this discussion, the lesson. How can you avoid these costly mistakes? And what should you do differently to start building wealth today? This is the turning point, where we take the painful lessons from the past and turn them into actionable advice that will set you on the path toward financial security and success. Let's just recap the examples. Example 1. The danger of stagnant savings. Example 2. The perils of waiting too long to start investing. Example 3. The hidden cost of debt and the importance of paying it off. Example 4. The power of diversification. So let's talk about the lessons you can learn from these examples and how to build your wealth. Lesson 1. Start investing early. Time is your greatest asset. The most important lesson from the previous examples is this: start investing as early as possible. Time is the one factor that compounds wealth in a way that nothing else can. If you take one thing away from this entire conversation, let it be this: start now. Even if it's just a small amount, every dollar you invest today is working for you tomorrow. You don't need to have a huge sum of money to get started. The key is consistency and the compounding effect. If you begin investing $100 a month at a 7% return over the next 30 years, you could turn that initial $100 per month into more than $100,000. But if you wait until you're in your 40s or 50s, you'll lose out on the compounded growth that could have been accumulating over the previous decades. The earlier you start, the less you have to invest overall to reach your financial goals. Time allows you to take advantage of the power of compound interest, which is essentially your money earning interest on top of interest. Without time, that compounding doesn't have a chance to work in your favor. So, if you're young and starting out, start investing immediately. If you're older, don't get discouraged. Start now and make the most of the time you have left. Lesson 2. Pay off high-interest debt first. Another critical lesson here is to prioritize paying off high-interest debt as soon as possible. The longer you carry debt, especially credit card debt, the more it compounds against you. Think about it. Every month you carry that balance, you're paying interest on the amount you owe, and that interest can quickly exceed the amount of your original debt. In the worst-case scenario, your debt spirals into a mountain that's difficult to climb. If you're dealing with high-interest debt, here's what you need to do. 1. Stop adding more debt. Don't take on any new debt. The more you add, the worse the problem gets. 2. Focus on paying off your debt. Look at the balances with the highest interest rates, typically credit cards, and tackle them first. This is called the debt avalanche method. You pay off the highest interest debt first, saving the most money in the long run. 3. Create a budget that prioritizes debt repayment. This means cutting back on unnecessary expenses, eating out less, canceling subscriptions, and finding ways to live frugally while you pay down debt. If you're able to eliminate high-interest debt, you can take that money you were paying towards interest and start using it to build wealth instead. And when you're debt-free, the sky's the limit. You'll have more money to invest, to save for the future, and to create financial freedom. Lesson 3. Build an emergency fund first. Before you start aggressively investing, it's essential to have an emergency fund. Life is unpredictable. Unexpected medical bills, car repairs, job loss, or a sudden emergency can strike at any time. If you don't have cash reserves, you'll likely find yourself dipping into debt to cover those expenses, which is a huge setback for your financial progress. The goal should be to set aside enough money to cover 3 to 6 months' worth of living expenses. This fund will serve as a safety net, giving you the peace of mind to know that if something unexpected happens, you won't have to rely on credit cards or loans to cover it. How to build your emergency fund. Set the target, save at least 3 to 6 months of living expenses. Start small, contribute regularly, even if it's a small amount. Keep it liquid. Use a high-yield savings or money market account for easy access. Once your emergency fund is built, you'll have a cushion to fall back on, and you can move on to the next step of your financial plan, building wealth through investments. Lesson 4. Diversify your investments. As we discussed in the examples, diversification is a critical concept in investing. The idea is simple: don't put all your eggs in one basket. By spreading your money across a variety of asset classes, you reduce risk and improve the potential for returns. How to diversify your investments. Stocks and bonds balance risk and reward by mixing high-return stocks with safer bonds. To diversify assets, consider real estate, precious metals, or cryptocurrencies if comfortable with risk. Use index funds, ETFs, easily diversify with funds that spread investments across multiple assets. Diversification doesn't guarantee profits or protect against losses, but it's one of the best ways to reduce risk and position yourself for long-term financial success. Lesson 5. Be consistent and patient. The final lesson is about consistency and patience. Building wealth doesn't happen overnight. It requires a long-term perspective, discipline, and consistency. The key to financial success is sticking to your plan, whether that's investing a certain percentage of your income every month, paying off your debt, or saving for an emergency fund. How to stay on track. Automate your savings, set up automatic transfers to ensure consistency and avoid the temptation to spend. So be patient. Wealth takes time to grow. Stay committed despite market fluctuations. Review and adjust. Reevaluate your financial plan periodically to align with changing goals. Remember, the road to financial freedom is a marathon, not a sprint. The more consistent you are, the more successful you'll be. Now that you've learned the essential lessons for managing your finances, it's time to put them into action. The mistakes of the past, whether they involve saving too little, waiting too long to start investing, accumulating debt, or failing to diversify, are all part of the journey. But now that you know better, you can do better. By starting early, paying off debt, building an emergency fund, diversifying your investments, and staying consistent, you can put yourself on the path to long-term financial success. The greatest lesson of all is that financial freedom is within your reach, and it starts with the actions you take today. Make the decision to invest in your future now, and you'll reap the rewards for years to come.